love the channel and find it useful in becoming a happy retiree. Subscribe today. Markets just continue to grind higher for the week. Amazon saves a company, or at least it looks like that on the surface, for once, as opposed to complete destruction like they've done the entire year. Washington, let's go to that. Washington continues to disappoint. At least if you're trying to get something, you hope that legislation is going to get done. Washington continues to disappoint. And the Trump trade sectors that we talked about at the end of last year, the beginning of this year, tell a sad story for the Trump agenda. At least the market is. But they're missing something. They're missing something very big that's about to happen with legislation. They're missing the tax and PR tsunami that's about to hit us when it comes to tax reform. We'll talk about that here this morning. So tune in to that. And then earnings continue to be the story. Just a tremendous amount of earnings that have already happened. We're about to get there again this week. So far, 97 of the S&P 500. So let's call it about 20% of the S&P 500 has reported second quarter earnings so far. 74% of those companies have topped expectations. So we are seeing not just strong earnings. So that's the profit side. So that's great, but that can be controlled by two things. One, better margins because companies have continued to cut costs, but that's not enough. We want companies to be doing this with more and more revenue in expansion mode, not just cutting the bottom line to boost profits. You need both sides of the equation working to have a healthy stock market. And that's what we've been seeing. So we're not only seeing better profits, but they're coming on better revenue as well. So we're going to have a giant week again next week. But so far, so again, first quarter, and again, this is what drives markets. It is company earnings, it's profits. First quarter, around 15% year-over-year growth. This quarter, another close to double digit, probably around 10%, we're going to see earnings come in. So this is a healthy market underneath the surface. Yes, you continue to see markets trickle higher, grind higher, wherever you want to look at it. For the week, the Dow actually down 0.25%, but the S&P 500 up another 0.5%, up 10%, 10.4% in 2017. NASDAQ up again, another 1%, 1.1% for the week. So there's a lot happening here in the quiet of the summer. Washington isn't quiet. The stock market, yes, volumes are as low as we've seen them, but it doesn't mean that there's not activity, and it doesn't mean that there has not been progress. So it's been a very interesting couple of weeks here for markets. And earnings will continue to be the story, and Washington will continue to be the story. And as I was trying to think about this week and really what matters to you and I as investors, or you and me as investors, what do I really care about? Well, I always care about the earnings side, but so much right now is driven by Washington. So I want to dig into those numbers and see what's happening under the surface. So a couple examples, if you look at the earnings story, let's go back to that for a second. Microsoft reported this week, markets loved it. Their cloud business is growing 13% revenue growth in the past quarter. Visa, big earning numbers, revenue $4.6 billion for the quarter, profits up 26% year over year. Netflix, another world dominator. Adding over 5 million subscribers in just one quarter. Goldman Sachs, almost $4 a share in profits, estimated profits of $3.4 billion. And what is again fascinating, that stock actually didn't do all that well. But GE, here's another not so hot number. Revenue dropped, and this is part of the reason the Dow was one of the three and out of the averages that didn't do that well this week. Revenue dropped 12%. So it's no wonder they're getting a new CEO. Jeffrey Immelt will step aside next month. John Flannery, he will take the reins. Microsoft for the week, good earnings equals a decent stock market performance of 1.2%. Visa, the stock itself, after good earnings report, up 2.5%. Netflix, after good earnings report, up 16%, the stock. So that's what drives the day. And that's what will continue to drive the day here on Wall Street. Actually, I'm on Peachtree, by the way. It's already 80. I can't even believe, I think this thermometer might be broken. Is it really 87 degrees? I can't even believe that it's that hot this early in the morning. I guess it just stayed hot overnight. So Amazon, SOS. Now Sears showing a little bit of sign of life. So just a little bit signs of life. So instead of Amazon sinking ships like it's done to stock prices in so many different sectors, and again, think retail, think Macy's, the carnage we've seen in that, in Kohl's and retail stores, and then this year targeting the grocers. We saw big companies like Kroger, one of the largest grocery stores in America and around the world, dropped about a third of its value in this first quarter, a lot of it due to Amazon. May have actually saved a sinking ship this week with the announcement that Amazon's going to start selling Kenmore, which is the Sears appliance line. And you can do it straight from Alexa. Hey, Alexa, send me a new refrigerator. Now, I'm not sure how that's going to work, but evidently there in the United States, it's something like 2, 3, 4% of appliance sales are done online. Arguably not a lot. Evidently, if you go to other countries, particularly Europe, it's a much more common practice to order an appliance online. So when I saw that, initially I thought, well, who's going to buy a microwave or a dishwasher or a big refrigerator, for goodness sakes, over the internet? Well, the answer here is that it does happen, and it's something that could really take off. So you saw the stock price jump tremendously this week for Sears. At one point, Sears was up 25% on the week. For the day, though, that with the Amazon announcement, they're going to start selling their Kenmore line, up 10% on the day. So more astonishing than all of this, though, probably goes back to Washington and their lack of capability to come to any sort of terms. And this week, of course, new health care. There's going to be a vote next week. I don't expect anything to get accomplished again. And we've got to consider health care legislation. Unless there's a Hail Mary next week, I'm going to just call it completely dead. So after 8 years of Republicans campaigning against Obamacare, it's an astounding turn of events. Agreement just can't and won't be reached, and really until Congress is literally forced to do so. And right now, the fire in the building is still contained to the stove. There'll be a time when it spreads to the whole house, and there'll be a time when it gets so bad that something has to get done, and there'll be a time when Congress is forced to do something, either shore up the existing program, because it will fail as is. That's agreement across the board. Everyone knows this. Costs have gotten too out of control. Or they finally pass some sort of compromise plan or a version of one of the compromise plans already on the table at some point. And that's coming, but it's not until the fire spreads from the kitchen. But for now, I'm going to say it's off the table. The budget and the debt ceiling are up next, likely in August. And then on to tax reform. And that's what I want to talk about today. We talked a lot about it at the end of last year, and you heard a lot about this Trump trade. But right now, it looks like the Trump trade's missing something. So the market itself right now is pricing in that the Trump agenda is over. And that comes largely in the performance of the sectors that did well right after the election, at the end of last fall, and then what's happening this year in 2017. So if you hit the election from, let's look at November 8th to the end of last year, as soon as Trump was elected, what happened? Financials through the roof, up 17%. Telecom up 13%. Energy up 9%. So we saw this real lift in all the sectors that Trump's agenda and the new folks in Washington would have some sort of a benefit towards these sectors. But right now, what we've seen is that those very sectors that did the best right after the election last year have effectively done the worst so far in 2017. Financials up only 7. So first of all, this relative to the S&P 500, the S&P 500 is up over 10% on the year. Financials up closer to 7. Telecom down 7. Energy down close to 12. So we have seen the very sectors that were celebrating, this new agenda is going to help our business. The stock market loves these sectors. As soon as the agenda looked as though it wouldn't get, and this is not just one particular piece, but the Trump agenda as a whole that includes healthcare, that includes infrastructure, that includes tax reform, repatriation of foreign assets, all of these things that were supposed to get done as a package, the market's saying, well, we don't think anything's going to get done. Evidenced here by this last couple of weeks with healthcare. You have this phenomenon that when Trump got elected, we have a new Congress, we have a GOP majority, and the thought was, well, we got all these things are going to get done now finally, right? You start with healthcare, you do infrastructure, you do less regulation, you have a big tax reform that is not just individual tax reform, which is gigantic, right? But corporate tax reform, which also could be a driver for higher wages. So that's gigantic. And the agenda is the total outline of what this administration wants to do. And in the beginning, in November and December and January, there was this great optimism that, hey, all of these things are going to get done at some point. And what did it do? It lifted all these sectors that were supposed to be the biggest beneficiaries of the Trump trade. And you saw financials up 17%, telecom up 13%, energy up 9%. Well, and that was just from November to the end of last year. Now, this year, the numbers are very different. Those same darling sectors have come under pressure. And these numbers now, these numbers are as of just Friday. I just did these numbers on Friday. So market up about 10.3, the S&P 500, let's call it 10.4%. You have sectors like technology that did terribly under the Trump trade, up 1% under the Trump trade last year, up 18% this year. Healthcare after the election was only up 1.2%. This year it's up 17%. So what did not do well after the election has done very well. Those are the leading sectors of 2017. What did do well, financials, telecom, energy, are the bottom sectors this year. Energy down 13.5% this year. Telecom down 7.5% this year. Financials only up 6.5% relative to the market at over 10. So the market is saying to us, hey, we don't think that the Trump agenda is going to get done. At least that's what the market is saying. And I think the market's missing something. So and here's what I mean by that. So you've got this, and let's call this the Trump tax reform book tour is about to take place. Let's call it a PR, public relations tsunami. When you release a book or movie, you know how it is. You see 1,000 commercials, you hear about it on radio and TV and billboards, and when you're watching a YouTube video, it pops up, and it's a public relations media blitz tour. And that's what's coming when it comes to tax reform, despite healthcare not working. Several sources in Washington have noted that there is and these are my sources. One of them has to do, one is the Strategas Research Group that we do a lot of work with and have for many years. They're in Washington, former lobbyist for the Bush, under George W. Bush. So very, very, very much on boots on the ground. Have noted that in the last couple of months now, there is a tremendous amount of work actually getting done right now in tax reform. So we've seen the administration, I think, do a very weak job on selling healthcare reform to the American public. They effectively had a bad PR strategy. Mostly because they themselves don't have a clear-cut good answer to the problem. And quite frankly, it's an almost impossible problem to solve. So it's a difficult book to sell. It's like trying to sell a new book with a really bad title. It just doesn't work. But their next book, or the next book that's coming out, is a much easier sell. The title, Lower Taxes. Subtitle, How to Put More Money in Everyone's Pocket and Grow Everything Under the Economic Sun. And you know what? That's a book that's easy to sell. That's a book that's going to sell. They're also, I think, doing a very good job of how they're letting this slowly get the word out. They're creating a real groundswell. They released this wonderful book trailer. Remember this? Just a couple of months ago. Remember this? Basically a one page, big font, simple, easy to understand, and it was skeletal enough that people now can, to some extent, fantasize about how they want it to go. So you read this one pager, couple bullet points, you think, oh, well, that could be good for me. That looks good. And the public is starting to fantasize about the best parts of it getting done. Think about it this way. CEOs love it because they love the thought of lower corporate taxes. And they also love it because the thought of this repatriation holiday for cash. We know that there's over $2 trillion offshore that hasn't come back to the U.S. because it is going to be taxed. And now there's going to probably be a tax holiday there. American families love it with the prospect of 1% to 3% lower tax bill. Business owners love it, the thought of maybe adopting lower business tax schedule for their own personal taxes. So there's a chapter in the book that appeals to everybody. And they've been giving it time to marinate with the American public. And that's the mark of a good PR campaign. I think that's what's happening. It's starting right now. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.